Everybody, welcome to the No Shill Zone. Your favorite data duo is back at work here, even on a President's Day holiday here in the U.S. How are you doing, Ben?
Pretty good, Gareth. How about you?
Good, man. So where do you? I'm going to throw it to you. Where do you want to start today?
Well, I mean, of course, I think people would probably want us to start with Bitcoin because it's hanging out at 52K, had a nice push up above the spot ETF highs, and maybe we could just sort of jump in about where do you think we go from here? Do you think there's any more room in the short term to go higher? I mean, Ethereum, ETH has continued to move up, even
Yeah.
though Bitcoin has been somewhat still the last few days. So, what are your thoughts about that?
Yeah, so a couple things here. So if we just jump over to this chart, and this is the Bitcoin chart, right? I always find these things fascinating because when most people look at charts, they think it's just chaos, right? It's ups, downs, lefts, rights, whatever it is. But in reality, if you take a look at the lows in October of 2023 and you connect it to the exact low of January 2024, that line, there's a parallel you can bring up, and it literally gave us the high here before this consolidation move, the high of the spot ETF approval, and then also the recent high right here. So just as a technician, and again, this is purely data driven, is that I look at that and I say, okay, well, in general, we pull back off of these lines. Now, it doesn't mean that every time you do, eventually you can break out of it and go to the upside. I think we were talking about just before we started the show that, ultimately you can go up for longer periods than anyone expects, to be honest, before you get any sort of corrective move. So right now, again, I am looking for a little bit of a pullback in Bitcoin. I don't know how deep it's going to be. The pivot point that I'm going to watch for is the previous high. So I always rotate back to the previous level that we were rejected from. In this case, it's the 49,000 level right here where the spot ETF was approved. I think as long as we stay above this 49, then I think you look at it and say, okay, neutral to positive bias. Yeah, we could pull back a little off this trend line. But if we were to break below 49 and essentially have a failed breakout, that for me at least would be where I would start to say, okay, this could turn out to be a bigger move to the downside.
What's kind of interesting is if you look at sort of the ROI of Bitcoin as measured from key points, like, if you want to take it from like if you look at like, as measured from the 69K peak
Mhm.
and you compare the current cycle, the screen line with the prior two cycles, it's notable just how much above the last two cycles we actually are right now. In fact, as measured from the peak, the last two cycles, of course, it happens to line up with the with the pandemic drop. But even if you just sort of fast forward out of that, you can see by day 850, those two cycles, those two prior cycles, were still 65% down from their highs,
Mm.
which is, I mean, that's substantial. I mean, a 65% down from the high is quite a substantial level to be at, considering right now we're not that far away, right? I mean, we're at 52K. The highs are, of course, in the 60s. I mean, it does show to some degree that we are ahead of where we were at the same time last cycle, and it's kind of reminiscent to me, if we don't even look at this cycle, how the cycle before this one, there were periods where we got well ahead of that prior of the cycle before that one, right?
Mhm.
There's two key areas where it happened, right? The 2019 rally that sort of faded once the rate cuts finally arrived. And then we had another rally later on. This was, after all the money printing, all the trillions printed, and of course all the all the major buys by by MicroStrategy and sort of spend, and even Elon Musk at Tesla, they bought Bitcoin over here. And so you can see that we certainly get ahead of where we can get ahead of where we were in a prior cycle that happened last cycle. So kind of seems like we're doing something similar once again, where we are and again, it's really impossible to predict exactly where there will be a pullback. The thing that I would remind people of is that this pullback here in 2019 that finally occurred was after, or as it was before the first rate cut, but also it was after the Bitcoin dominance retraced back to the zero point 0.5 fib.
Right.
And that's still, that's still a little bit higher than where we are right now. That's about 56%. And I'd be curious to hear your thoughts on the dominance, because I mean, it's been in a macro uptrend forever. We've had some pullbacks along the way. It seems like we're in one of those pullbacks right now.
Yeah, let me just bring up the dominance chart on mine and just see. I just have some old trend lines that I've been watching. It's kind of interesting here because, again, I don't even know if I've looked at this chart since we talked a week ago. And you can see the lines I had in here. And it's interesting because if I just extend them out, look at what we just hit on dominance right here. And then you can see we kind of bubbled up and it tried to break out here and then it kind of got rejected. So, just something to take a look at on that. But if you zoom out and what you always want to do, at least what I do, is if the short term, and this is just zooming in on the daily dominance chart, what it looks to me is like a lot of chop, right? A lot of chop. But if you go to your weekly chart, it gives you a much better, bigger term view. And
Mhm.
so, again, for me, I'm seeing like where is dominance running into resistance? Well, there's a clear area right under here where if we draw that trend line through, that's your area that it keeps bubbling up against. If we can break through this like 54, 55% level, it looks like it's clear sailing to about 57 or so right up here. So again, just interesting to see that. But one thing I wanted to pivot to is I was just looking at a couple different charts. Does it bother you that this is by the way, this is a chart of Bitcoin versus the S&P 500? And does it bother you at all with Bitcoin that the S&P is making new all-time highs, but Bitcoin hasn't, or is it just because Bitcoin is much more volatile of an asset class?
Yeah, no, it doesn't really bother me because it's actually quite in line with what happened last like late business cycle QT, before lower interest rates came. I mean, like last cycle, if you look at the S&P 500, I mean, we were making all-time highs a lot sooner than we were this cycle. After that sort of that,
Mm,
midterm year drop, right? 2018 had a pretty big drop in the S&P 500 just like 2022 did. You can see that in 2018 we got to new highs really by about April of the pre-election year. This time it took us all the way until basically the end of the pre-election year, or maybe or early this year. I don't remember exactly the day that it happened, but um, and you can see that while the S&P was making new highs, Bitcoin was not, right? I mean, it was pretty clear over here that Bitcoin was not, and it took Bitcoin really until that pivot to looser monetary policy actually occurred that it was able to make that larger move to the upside. That's not to say that it can't do it. I mean, we're more connected now to traditional finance, I think, because of spot ETFs.
mm.
Than we were back then. So that might be something to keep in mind. But it's not really that surprising that Bitcoin hasn't done it yet. Again, last cycle it didn't make that move until after looser monetary policy. Right, we actually got pretty close. Right, I mean we rallied all the way up to like 14K, and the highs back then were 20K, but we didn't actually make it there until that shift to looser monetary policy arrived. There's another chart, by the way, Gareth, that it's not. I used to enjoy looking at it more until they actually changed the definition of M1. But if you
Mm.
look at like, Bitcoin divided by M1, there was this 2019 rally over here. And again, it's funny because we always, when we think about like, the last bull run, we think about 2021, and a lot of people don't really think about 2019. But when you account for M1, um, you can see that the 2019 rally was about as impressive. They did though change the definition of it somewhere over here, but despite that, I don't know if it's a coincidence or not. That was sort of the same level.
Still, yeah, still
Yeah,
interestingly how it works out that way.
but maybe looking at it with respect to M2 is a better way to look at it. I mean, you can see that last cycle there was a pretty big rally by Bitcoin. We cooled off a little bit around rate cuts, and then we got another move up on the other side of rate cuts. So maybe something like that is playing out.
Interesting, interesting. Well, pivoting over to ETH here, I just wanted to show a chart here that I find fascinating. Is that basically ETH has had this up channel that we've been stuck in since 2022, right? We hit the high, we came down to the low, didn't quite get to the high here, came down to the low, then hit the high here, and had that pullback. And then, interestingly enough, we did break out above this line here, and then it back tested. You could see two candles here piercing this line, but it held, and we have seen it move up. And so I think the big question is this money rotation? I mean, Bitcoin obviously is kind of stalled out here. Some alts, by the way, I find it interesting. There's certain alts that are making short-term highs, and then other alts kind of have been left behind a little bit. Like I was looking at a chart of like INJ, which trying to move back up, but it's still off of its highs. But yeah, I mean, I'm just curious about your thoughts on where Ethereum is headed in the near term here.
Yeah, I'd always, I'd first look at say like the ETH Bitcoin pair, to see what that's looking like. And I'm still somewhat stubbornly under the impression that it's probably just repeating these same sort of structures that we've seen in the past, right? Where you put in these lows and then eventually you break down from it. But there are bounces that occur off the lows, right? There's like a pretty big bounce here. And actually, if you look at the last cycle, right? If you look at sort of the last cycle by ETH Bitcoin, after getting this bounce, we sort of came all the way up, just like we did right here. We actually came back down below the 20-week SMA and then got a bounce in February, right? Which is
Hmm.
kind of what's happening now. I would look probably for ETH Bitcoin to not go too much higher. I mean, it could certainly go a little bit higher here, but I still think that liquidity will flow back to Bitcoin eventually, especially as we get closer to the halving. So, and again, that goes back to the whole Bitcoin dominant stuff. I do think that it has taken a bit of a hit recently, but I wouldn't be surprised to see it go. Look at this. Here's another way to look at dominance. Kind of looks like maybe it's in sort of an ascending triangle here,
Yep.
where it's put in a low, put in a higher low, and it's really struggling to break above that 54% level. So I think if you get a weekly close above 54%, then you could very quickly move to those levels that you mentioned. But as far as ETH USD, I just talked about this somewhat recently on my channel. I'm it's interesting because there's certainly two different ways to look at it. You can look at it through sort of like the cyclical view of ETH, which is basically looking at this same chart, but instead of looking at it for Bitcoin, you look at it for Ethereum, and you kind of see, all right, we're basically doing what we've historically done. We've had diminished volatility to the downside. If you look at it in terms of monetary policy, what's fascinating is that this move over here is essentially a 10% move of this one, right? So like, look at this, like that's an 84. This is about 10x higher, right? And then the secondary tap of that ascending wedge was about 104. Here it was about 1,000. And then the third tag of that trend line was about 150 over here. Believe it or not, it was 1,500.
Hmm.
And then we broke through the trend line, right? We break through it, go up to about 270, 280, just like we did here. We got a pull back to 220 to 230, just like we got one to 2,200 to 2,300 there. And then we finally got a blow off top all the way up to a weekly close of around 300 with a wick up to around the 360s. And of course, what's fascinating about all of that is it occurred going into those first rate cuts, right? It occurred going into those first rate cuts. So I'd be curious if it plays out like that here in the not so distant future, where ETH continues to show short-term strength against Bitcoin, but then as you get closer to the halving, you get March and April, Bitcoin takes over, ETH Bitcoin goes back down to the May lows, and then you get some type of uninversion of the yield curve as the Fed cuts, and then you see ETH USD fade back down until we get sufficiently back to quantitative easing.
Interesting, interesting. Yeah. Speaking of like the economy, I think a couple things stood out in the past week for me. So we saw the CPI and PPI numbers coming out pretty strong, right? They were hotter than expected, and it kind of threw the market for a loop. Which up until about a month ago, we were hearing that 6 rate cuts, then it was 5. I think it's actually down to 2, 3 to 4 now is what's expected.
Mm.
But I think that was something that stood out to me because then it opens the door to the potential that the Fed won't be able to ease as much as the market wants if inflation is not coming down towards 2%, right? So that's a
Right.
negative for risk assets. Number two, retail sales, right? We know the backbone of the US economy is the consumer. And retail sales came in really weak. And one thing I just want to give everyone a heads up on is tomorrow morning, Tuesday morning, Walmart and I believe it's Home Depot report earnings. And that will give us some color on, is it just a fluke that retail sales were weaker than expected, or is there something more going on with the consumer in the US economy? And I'm still in the camp where, like, I still think that the crypto markets are influenced by risk assets, meaning that if the stock
Mhm.
market's going up, generally crypto probably trends up because there's more money being created. One chart I just wanted to show you guys here, I think this is a super interesting one, is this is basically the stock market versus GDP, and we have now made a new high in terms of valuations in the stock market versus GDP down here. And it's just, again, these type of charts are important. You're now at such a massive amount. I think it's about a 50 trillion, almost 51 trillion in stock market cap in this country versus GDP, which is much, much lower, obviously. So little things like this start to get my attention in terms of, is the stock market overvalued? Are we at risk of a potential bubble? One of the other charts to show is SMCI. This was an incredible move. I mean, something that was trending on Twitter because it was so insane. By the way, when it started trending on Twitter on Friday morning, that was actually the top. And so just for everyone out there, watch that. I use that as a personal indicator. It's not the only indicator. It doesn't determine if I short or go long, but this fall was insane. 30% from the opening highs basically in one day to the downside. But look at that move. I mean, that was parabolic. It looked like a crypto, like it looked like a meme chart to me. It definitely did. So I guess my point is that I'm continuing to watch the stock market and continuing to watch signals like this, just because I do think it influences the crypto markets if we did see a big risk off situation in the stock market.
Yeah, Nvidia earnings are this week, right? I think they're on Wednesday.
Yeah, Wednesday after the close. Yep, absolutely.
Yeah. I know some people have made the comparison of Nvidia to Cisco from the .com. I mean, when the Cisco bubble finally popped. And by the way, I think markets are expecting an 11% move from Nvidia. I think that's what options are pricing in, which is kind of funny because the last two earnings, I think Nvidia ended up being relatively flat. But yeah, I mean, I think Cisco didn't actually start to break down until March of 2000. I believe it was March where it finally started to show some weakness. So, I mean, if Nvidia, I don't know which way it's going to break after earnings, but I mean, if it breaks up, then maybe you just kick the can down the road another month or something. I don't know. As far as
sometimes when a company reports the final accumulation of buyers and stopping out the last few shorts, that will be, and then that's actually the top. You actually get this kind of blow off top effect. But you're right. This is the Cisco chart here, guys. But Ben, you're bringing up a good point. Is Cisco's never gotten back to those all-time highs that it hit in the .com era. And I know people today, a lot of the younger generations, it's like, oh, well, what's Cisco? It's not even that big of a company anymore. Well, this was like the equivalent of the AI narrative for stocks is what Cisco was. It was the backbone of the internet, and the internet was just becoming a mainstream thing at the time. And this was the only game in town. Cisco was really the only game in town for the backbone of the internet. So it was the equivalent of the AI chips that NVIDIA is putting out right now. And that's why, it's good to draw these types of comparisons. You've had bubbles along the way. In fact, I was going over this with other groups and talking about how, every so often you have these parabolic moves. We had them in the marijuana stocks. We've had them in the crypto markets. We've had them in the solar stocks. And ultimately, when the blow off does occur, it's a big drop. I mean, these things really do collapse. And if we just take a look at the NVIDIA chart, very, very eerily similar in terms of looking at that chart and some of these past bubble blow-offs. And again, there'll be lots of naysayers. They'll say, oh, it's different this time. I've heard that for every bubble, though.
Can you go back to the Cisco chart for a second?
Absolutely.
One thing that's one thing that's super interesting about it is, like, imagine that bubble in 1998 to 2000 just didn't happen, and the chart just slowly trended up. The sentiment around the stock would be completely different,
Yeah.
It's just that because that bubble existed, right there, I think sort of a lot of people compare it to that high, but otherwise it's basically just been trending up for the last 20 years. So, as far as NVIDIA goes, my thoughts are that I mean, AI is probably going to be something that completely changes our lives over the next 20 years. I don't think anyone's disputing that. It's just that when you get these types of moves, it's basically pricing in, perfection for the next 10 years. And there's going to be competition to NVIDIA. I think that.
Well, right now the margins for NVIDIA are like 80%, and there's no way already AMD's coming out with chips, and like all these other players, they're all racing. And by the way, China, we're kind of banning some of these chips from going to China. So China's like on the fast track to produce a bunch of these chips themselves. At some point it becomes commoditized, I think, and the margins will fall off a cliff.
That's what happened with Cisco, is they commoditized. And that was why a lot of what they offered did. That's what happened. And then the valuations fell quite a bit. So, yeah, I mean, that's probably what's going to happen. I think the hard part is no one knows where the high, no one knows where the top's going to be.
No.
And there's no really rational way to predict exactly. I mean, look at the Cisco chart. Who would have known that was exactly where it was going to finally top out in March of 2000? It's impossible to know that was the level.
No, and you're right. And I honestly thought the top on Nvidia was months ago, if not more, and it's defied gravity and continued to push up.
Mhm.
Part of that I think is liquidity, and I think it's just we've gotten into this market very similar to 2021, where people aren't really questioning valuation. They're not thinking ahead. It's just like, hey, throw money in because it just makes money. Money in the market makes money, which again to me is a little bit of a warning sign. Doesn't mean the top is next week or next month, but it's just like these are red flags that are starting to be in the market that investors probably should be aware of.
I'm curious, what are your thoughts about? I mean, because that's like an individual stock, right? I mean, Nvidia. I mean, obviously, if Nvidia were to collapse, like it would take the stock market with it. But
Yeah.
to a certain degree, I mean, the stock market is still much bigger than Nvidia. So I'm curious. One of the things that has been discussed for the last couple of years and is always discussed really during aggressive rate hiking cycles is whether the Fed will achieve a soft landing or a hard landing or no landing. And I'm curious where you stand on that. Like, what do you think the risks, like, what are the risks of a soft landing? What are the risks of a hard landing? What would you be looking for to look for confirmation of either one?
Yeah, so one thing just and I'll just show this quick first. This is kind of one of those freaky trend lines that people should be aware of. This was the high of the Qs, the Nasdaq 100 at the dot-com bubble high. Look at what we hit in 2022 and look at where we currently are right now. So again, doesn't mean it's the high, of course, as we all know, but you just look for these little things that can give you a little insights into the charts. But for me, when it's looking at like, potentially whether it's a soft landing or not, you have to look at the labor market, right? So labor market's probably the number one thing. So far that's held up, but I would like to just point out, and let me just try to go to this chart here. I don't have it pre-prepared, but if you look at U6 unemployment, U6 has started to actually pop up a little bit here. Let me just get rid of these. And what I've noticed is that U6 is the leading indicator for recessions, meaning that the overall employment rate doesn't change. For those of you guys out there that don't know what U6 is, it basically gives you it's underemployed, right? So it's someone that wants a full-time job, but they can't find it, so they take part-time work. And the concept behind that is that initially a company will also say, hey, listen, we can't keep you on full-time because things are slowing down, but we'll keep you on part-time. And so these are people, again, this is a more accurate view of underemployed, which can be a leading indicator because before a company fires someone, they oftentimes would say, oh, well, we can't keep you on, but we'll keep you on part-time. And if you look at this, even though the unemployment rate hasn't fully started to pop up, we have seen U6 back in 2000, before the 2002 recession. U6 spent about 12 months going up before it hit the recession. And if you go to 2007, same thing, 12 months of upticking in the U6 before the Great Recession. And then COVID was a little bit of a black swan. No one necessarily anticipated
Right.
it. But even there, you saw a little bit of an uptick first. And if you go here, right, if we just zoom in, let's just do the 1 year. This is very clear that U6 is starting to incline. So to me, that's an indicator that a recession is probably coming. Even if the unemployment rate itself isn't showing us that, or the hirings. The other thing is, I think the consumer. We talked about it earlier, right? The retail sales. If this economy is going to continue to be what it is, the consumer has to keep spending. And I do wonder how much the consumer can do it when you see the retail sales weaker. We see credit card debt north of 1.1 trillion now. There seems like a lot of pressure on the consumer now starting to kind of develop, and at some point there'll be a breaking point. So,
Right.
what about you? What are your thoughts on this stuff?
Yeah, well, I mean, the consumer, looking at prior business cycles, the consumer can definitely stay stronger for, I think, longer than a lot of people think. Um, and I think there's been a lot of, with all the money printing and whatnot, a lot of consumers, they've had some cash saved up, but as inflation continues to stay really elevated, all that slowly comes back down, right? Back down to historical lower levels. Yeah, it's interesting when you were showing that chart about like the unemployment rate or the U6 and how there was like 12 months of like a slow uptrend. Yeah, like pull it back up. I think, if you think back to like those cycles, imagine you were someone living through that cycle and seeing it go up, but not really seeing the sort of the larger move up, right?
Right,
It can be exhausting, right? Sort of waiting for that trend to actually occur. And, I don't think anyone wants to see people get laid off. It's just this is kind of what happens during aggressive rate
right.
hiking cycles by the Fed. I mean, I would prefer for everyone keeps their job. And I think the thing is like, look, this is a risk. Just start preparing for it. That, like, maybe prepare, maybe plan out for how you would, navigate a scenario if it were to eventually end in the same way that the other business cycles ended.
Yeah, and I would just point out too, it's there's so many eerie similarities, and again, similarities don't dictate future results, but whether it's Jerome Powell saying exactly what Ben Bernanke said in 2007 that we're going to avoid a recession, or there's just eerie similarities about this stuff, and then you look at like the U.S. deficit, the debt levels, how much higher we are in so many of these metrics. But at the same time, you look at money supply, and liquidity in the system has also increased, substantially, which you could argue is creating or helping elongate the bull cycle, right? The longer the growth cycle. But we ultimately, and this is the scary thing about it, is I've often delved into this thought, is would our overall economy in the long run be better with no Fed intervention or with Fed intervention? Because I've always argued that with the Fed intervening, they keep the bull market and the growth longer, but you don't get the natural recourse of the cycle, which is the recession period. And then when you get it, it's 20 times worse, like what we saw in '07 or '08, '09. And so, what are your thoughts on that? Like, do you think the Fed over the long term has helped, or is it potentially that they've just been creating? I mean, it seems like they helped because the economy's done better, but do we have to pay the price at some point?
Well, I mean, I think it certainly makes speculation more dubious. I mean, like, it's not like, rather than looking at like, some of the metrics that's, like the prior generation looked at more frequently, like price to earnings, all of that stuff. A lot of people in our generation, I feel like, don't even care about that stuff. It's all about, sort of riding the momentum, all this. Look, I think that there have been periods where it was appropriate, for them to do something. But I also think that over the last few years, they went far above and beyond what they needed to do. I mean, I think in 2021, when it was clear that the economy was heating up and did not really need them to continue to expand their balance sheet, right? They should have stopped then, and they should have started raising interest rates then rather than waiting until 2022. I mean, of course, it's easy in hindsight to say that, but it is something to consider. And by the way, like, here's some charts. Like, there's plenty of charts that show the labor market slowly softening up. This is like new hires in the manufacturing sector, right? It's dropping a lot. One of the ones that I think was a little concerning was the average hourly earning, or sorry, no, average hours worked per week had a pretty big drop, actually. The last report, down to 34.1, which is not what essentially happens. I think in the cycle is that the first thing that companies do is they reduce hours, right? They reduce people's hours before they lay them off, because think back to
Kind of
how.
like the U6, what I was mentioning in the U6.
Right. Well, it's
Yeah.
so hard. It's so hard to find good workers. I think that's been, that was something that's been challenging, or that's been a challenge for businesses for several years, is that it's really hard to find, a good worker, and they don't want, the ones that they have, they don't want to fire them and then have them go off to their competition and start working, right? So what they do first is they reduce hours, right? They reduce hours. That's a pretty common tactic. Eventually, if the Fed doesn't pivot, soon, then they have to start going over to layoffs, right? But I think, look, when it comes to the labor market, and there's a couple of things you can look at. One of which is what you were just showing, the U6. We know that it takes a year or more for it to slowly turn up, right? So in that time, or sort of in that regard, it's not really different, right? I mean, we've seen it take a long time before. Another way to look at it is to look at, say, the number of job openings per unemployed worker, and see, like, it's come down a lot from over 2 openings per unemployed worker to where it is now. It's at 1.44x. But a lot of this, I think, was just getting rid of a lot of the excess that was created post-pandemic. Yeah. So I think the hard part is, will the Fed actually start to cut rates before this continues to, to crash down? And as long as inflation remains at 3%, I kind of think the Fed's hands are still somewhat tied.
Yeah, I agree. I think that's a wonderful way to end it. I mean, pretty intense discussion today, folks. I hope you guys enjoyed it and the data out there. And as always, guys, follow everything Ben does. He's freaking awesome. Yeah, I would love to work more with him and figure out other things. So we'll talk a little bit about that more and more. But he's awesome, guys, and check out everything from his socials to his service out there.
Same thing with Gareth. Gareth has a great website, great socials. And, I mean, one of the things about Gareth, and we've talked about this before, is you know, like back during 2021, especially, you know, really early on, or, you know, I think like what, like October, November, but also you were raising the warning signs earlier as well.
Yeah,
You know, I mean, like it's the market can go on and on and on, right, for a long time and still stay at those highs, but eventually, eventually these risks sort of manifest. And I mean, I think Garrett did a great job of last cycle kind of warning people about that and saying, look, guys, you know, I know everyone wants Bitcoin to go to 300K, but you know, maybe that's not going to happen just yet. So again, like I think we're all long term. We want to see
absolutely.
Bitcoin do well over the long term, and I think we all think it will. Um, but yeah, like there's certainly risks that we have to consider. In the meantime, yeah, make sure you guys go follow Gareth. He puts out a lot of content, and I think we'll wrap it up there, and we'll see you guys
Wonderful.
a week from today.
Awesome. Have a great one, guys. Thanks for tuning in. Take care.